Dick's just reported this morning. They crushed, they increased guidance. They did an awesome job. And interestingly enough, though, NASDAQ is down 0.7, S&P is down 0.76. So it's kind of a big red day for the market. But let's see how Dick's is doing this morning. Up 9.3, not 11% now. Up 11%. I love Dick's. What a great store. I had to say that. I'm sorry. All right. So in the last year, they're up 67%. Year to date, up 46%. This is incredible. This company's crushing it. Last 10 years, 395% max right here. So let's see what they're expected to do, what they reported. In addition to Dick's, Chewy reported as well. And guys, look at this. Up 16.23% so far today. They now 17.5%. This thing is flossing. The market just opened a few minutes ago. So obviously things are very chaotic right now. But two retailers with two big reports. Now, back to Dick's here. Dick's reported $3.30 EPS versus 2.96 estimated. And they reported $3.01 billion in revenue versus an estimated 2.94. Really quick with Chewy, also a double beat. 15 cents reported EPS versus about 4% expected, and 2.87 billion versus 2.85 billion in revenue. So they crushed it. Dick's is now up 12%. Let's look at their release. Now, here's the thing that's great. 5.3% comparable sales growth. For Dick's, comparable sales are based on stores that have been open 14 months or longer. Delivers double-digit EBIT margin of 11.3%. Earnings per share of 3.3%. Raises full year 2024 guidance for comparable sales to 2 to 3% from 1 to 2%. Guys, that's big. If you look at Lowe's and Home Depot, I was a little concerned about the consumer saying, and this is why we shouldn't try to guess what's going to happen. But I looked at it going, Lowe's and Home Depot, people are pulling back from doing their own DIY projects. Is the consumer weaker than we thought? This consumer, Dick's is not a place you go buy low cost stuff. It's good stuff here. So I sit there and look at that going, okay, raises full year 2024 earnings per share guidance of $13.35 to $13.75 from $12.85 to $13.20. That's a big, it's almost $1 increase. That's a big number. I remember when this company, not very long ago, look at that, in the last 5 years, at the low of COVID, they got to $13.46. That means if you had the stomach, if you had the emotion to sit there and say the world was not going to end, and you bought Dick's Sporting Goods, you're up, what is that, 15 times in your money, 16 times in your money? That's incredible. Good for anybody who did that. That is awesome. Keeps climbing, up 13% now. Now, let's look at this company. $17.7 billion market cap versus $22.5 billion enterprise value. That difference is essentially the debt. Free cash flow of $940 million versus an average 5-year free cash flow $860. So, guys, retail ain't dead. Retail is not dead. Now, here are a couple other things I like about the company. Look at store locations. So they have this new specialty concept store where it's based on more experiences like batting cages, driving range, rock wall, etc. They've opened more of those. They opened a net 3 stores there for the quarter, 1 on their regular stores, and closed 2 of their regular stores overall. So overall, they gained about 2 stores overall. Now I like this because retail used to be, you just open more locations, you get more revenue. But the world of retail has changed. More online. I still do order from dicksportinggoods.com. I think it's a great website to order from. I think it absolutely is a great website to order from. So, and you just go in your store, pick it up, and you're done. I love the store. I always have a great experience going there. I have nothing. They also own Golf Galaxy. I forgot about that. We just brought this up. A few years ago, if you tried to go to Dick's Sporting Goods by going to dicks.com, you were met with a rather unpleasant scene. Now, though, it goes to dicksportinggoods.com because going to dicksportinggoods.com is way too long to write. They got smart. Somebody went to some weirdo who probably lived in Las Vegas and lived in his mom's basement in Las Vegas and wore velour or velvet, what's it called? robes and finally said, listen, pal, what's it going to take for us to buy Dicks.com from you? That is my assumption of what happened. I don't know if I'm right or wrong, but either way, that is the way it is. Now, guys, for Chewy, I will say this. This is their earnings press release. Make this a little bit bigger. Now, net sales of $2.88 billion increased 3.1% year over year. I'm not very impressed with that. I look at that thinking to myself, you're an online company that's still growing fast and your increase of sales is only 3.1%. That's my opinion. Let's see. Net margin, 2.3%, increase 150 basis points. That's good. EBITDA up $52 million to 100. So that's almost a 50% increase in EBITDA. Net income, also a $50 million increase to 137, which is about what, 60 or 70% increase. Earnings per share increase of 11 cents. Okay, so I look at this, like he said, like the CEO says, off to a solid start. This does not wow me. This is not a grow. I mean, I look at this going, Chewy, come on, you're a small company. Like, you should be growing like crazy. What's going to happen with Chewy? I don't know. I look at this saying, oh, a repurchase program of $500 million of Class A or B. So let's look up Chewy real quick. Let's see where the company has been. The company hit an all-time high of $120 a share back on February 16th, 2021, and then went down to, now it's up 22%. It was as low as $14 on April 25th, a little over a month ago. This company's $8.69 billion market cap. You know, could Amazon just go buy these guys? 0.78%, 0.78 price to sales ratio. I look at this as an Amazon play. Like, gross profit of 28%. Maybe Amazon buys them because listen, my wife, fiance, she loves Chewy. She's like, their customer service is phenomenal, etc. But we still don't buy everything from them. We still go to Amazon for things, etc. So that's my opinion on Chewy. So let's go analyze Dick's and see what it's worth. Now, here's their specialty store. It's pretty cool. It's a cool looking store. I like this concept. You know, it's a way of sitting there and saying, how do we get the consumer to come in and use our stuff? Listen, it's easy to go to Amazon and buy a bat, buy some golf clubs. But wouldn't you rather go to Dick's specialty store and say, listen, I'm going to try these things out. Let me try these things and then buy it there. I think it's a great way of changing the way in which retail is done. And I think that's going to be very important for any retail establishment going forward. You want to bring people in somehow. How do you bring them in? Give them a better experience they can't have online. That's going to be very important. So overall for Dick's Sporting Goods, I look at this and I look at it and going, listen, they've done a good job in sitting here and saying, let's change the way in which retail is done. Because it wasn't too long ago that Dick's was struggling. So let's see their 8 pillars here. 8 Pilla Thrilla. Look at that. I didn't even know there were 8 pillars. Now remember, you don't just go buy it because it's 8 pillars. Because even though the 5-year PE is 20 and the 5-year price of free cash flow is also 20, doesn't mean it's a great buy. You have to sit there. Let's see what analysts are expecting for the growth on earnings per share. Wow, look at this. Pretty steady. Not huge. 3.9, 6.5, 8.3, 7, 2.6, 8.4. Not aggressive, but if they buy back cheap shares as time goes on, and they're able to sit there and keep growing with inflation, their or nominal GDP growth, their revenue, they can do pretty well. And look at their revenue growth. Everybody has them as positive revenue growth. Can I just say retail location with 5-6 years of positive revenue growth according to analysts? So the question becomes, is it a reasonable price to pay for Dick's right now? It's up almost 15% now. This thing has changed a lot since we opened this thing up. So let me see. When was the last time I did Dick's? DKS. August of 2023. Here were my assumptions. I did a 10-year analysis. Look at this ROIC. I like this. 15.5 in the last 10 years, 18.7 in the last 5 years. Revenue growth. I did 2, 3, and 5%. Profit margin. I might be low, but I'm doing 6, 7.5, and 9. And their free cash flow, you know, the free cash flow, I think I need to change this to back where, because they have equated out their free cash flow essentially. So let's make this exactly the same. Now, look at PE. I did 10, 13, and 16. Remember, I've changed the way in which I've done things. Here's what I'm going to do. I'm going to do 13, 15, and 17 because it's retail. But it's proving to be a little bit different retail. Now, the question becomes, what is your margin of safety going to be? Because before, I had like 10, 12, and 14%. I'm going to put my 9% desired return in, but I strongly encourage you to put a little bit more margin of safety than you normally would, because 9 or 10% is what the market's going to do, right? You have to sit there and understand, like, hey, and if you're in our community, talk in the community amongst each other and say, what do you guys think about retail? I think that's an important conversation to have, because I don't think retail is going away. Retail is definitely not going away, but it's changing. And there will be a lot of players out there who do go to zero or get eliminated or get bought out. Is Dick's going to be one of them? They're proven to sit there and fight the fight that's worth fighting. And I think that you got to give them some credit for that. But I still think that if you want 9 or 10% return, go buy a long-term ETF. So if you're going to buy an individual stock, you need a margin of safety, because valuation's an art, the future's unknown, and we're human and we make mistakes. And also, this is retail. Retail, you got to put a little bit more margin of safety. And so let's look at this number real quick, based on it being, what's it worth in the market, to see, is it even worth going further on? I hit the analyze button and I get a low price of 125, a high price of 270, middle price of 180. So in my opinion, I'm not even looking at this thing right now for a while, because it's probably, if I put a margin of safety in here of 11, 13, and 15%, it takes my numbers to 110, 140, and 180. So I'm going to add it to my watch list, probably at 130. Guys, if you like this stuff, we do this 4 or 5 times a week. Subscribe to this channel for updates very quickly.